Traders, welcome to Smart Keys FX, your ultimate key to trading Forex. Be ready to perfect your skills. Capital is one of the most important components in the trading that a trader must protect at all time. For a trader, capital is an asset, an item that a trader cannot venture into the trading sphere without having that capital. Have you ever funded an account, made some small profit, and then taken one trade which ends up wiping the profit that you have made and even blowing your account? Now, to recover your money back, you fund another account or you fund the same account, then take some trades which may or may not give you some profit, and then there is this one bad trade which ends up wiping your account. Now there is one link in the puzzle that you are not having, because as a trader you cannot take or make any trade in the market without enough capital, and therefore capital must be protected at all cost. Like let's look at this trader who ended up taking a trade without putting a stop loss, and then the trade goes against his direction. Even if he took this trade in line with his strategy, but bearing in mind that trading is a game of probabilities, maybe because of volatilities and uncertainties in the market, something made this market to go against his direction. And if he could have used a stop loss, then it means that he could have protected his account. He could have had some money which he can use to take another trade in future. So the first question that I want to ask is, to what extent do you protect your account? What are the strategies that you are using to ensure that you protect your account or you protect your capital? So guys, welcome to this channel, the Smart Keys FX. Join me as we delve into looking how we can find the best way to protect our capital, because for you to stay longer in this game, you have to ensure that your capital is protected at all cost, and bearing in mind that trading is a game of probabilities. Every time you enter into a trade, you have to accept that there is a chance that you can lose or there is a chance that you can gain. But then, what can make you to stay longer in this market? Because even the most profitable traders also at times incur losses. But what makes them stay in the market for a longer period? What makes them have consistent market in the consistent profit in the market? It is not that they have exceptional strategies, but it is because of the effective risk management skills that they have. They have to protect their capital at all cost. So join me as we look at the best ways through which we can ensure that our capital is protected, and also one of the ways through which we can ensure that we keep on trading and we keep on making money, because we are here to make money, and you cannot make money in this market if you don't have enough profit. So the ultimate key to preserve your capital. Why do you need a stop loss? A stop loss preserves your capital as a trader, because as I said, you cannot trade without enough capital. It is an indication of your belief that trading is a game of probabilities, because as retail traders, we don't have the ability to control the movement in the market, but rather we join the institutions, the big banks, once we have confirmed that the market is trending in a particular direction. So the stop loss also confirms your confidence in your strategy. It is your acceptance of any outcome of your trade, and also a surety of peace of mind and time to do other things, because once you have put your stop loss, you have the freedom to leave the market running or to leave the trade running and go and tend to other things. It also gives you a chance to take another trade, because without enough capital, When the trade wipes out your capital, then you don't have another opportunity to take another trade, while knowing that the market will always present you with a number of opportunities. But once your capital is wiped out, then you lack that capital or equity to take another trade. What are the dangers of not using a stop loss? Traders become irrational after taking the trade, and this is one of the things which made me lose money at the start of my trading journey, because I know traders have also experienced this. You take a trade without a stop loss, and then you sit down hoping that the trade will go into your direction. When the trade goes against you, you don't close it. You sit down and watch the market going against you, because you have this false hope that the market will turn back and then you will make your money back. But then the market keeps on going and going, and within no time you will find that there is a margin call, and after that your account is blown. But then if you could have used a stop loss, you could have taken a small loss and then protected your capital, which then you can use in another trade. Not using a stop loss before taking a trade is dangerous, because our thought process becomes subjective after we have entered into a trade, and then we end up having poor decision making and poor judgment, and that will make your account to be blown. You avoid loss by not closing the trade with the false hope that the market will turn into your direction, and that is a recipe to blowing your account. So what is the best way to preserve your capital as a trader? The first one that we are going to look at is to use the stop loss in the right way, because I know we have a number of ways through which we can use to protect our capital. That is proper risk management, proper position sizing, and also not over leveraging, among others. But in this episode, we want to look at the best way to use our stop loss, which is you put your stop loss before entering a trade, because that is the best time that your thought process is rational and it's objective. Then never adjust your stop loss unless you are putting it at break even or locking your profit. Then let's look at a diagrammatical presentation of the effect of using a stop loss and the effect of not using a stop loss to your account. Let's look at the first scenario, where we have a market which has confirmed to be trending in the downside in the higher time frame. You can see there is this structure here has been broken by this leg. We also have another break of structure here, confirming that this market is in the downtrend. And then, as smart money concept traders, we identify the origin of this leg, which ended up breaking this level. And then we realize that we have 2 points of interest here. We have the first point of interest here, which led to the break of this structure, and then this point of interest here is also valid because we have an open price range here. So the market has two alternatives or two options that it can turn around. The market can turn around here in the first point of interest. The market can also use this level here as liquidity so that it can go up and then turn around in the second point of interest here. So the first trader focuses on the first point of interest here. He identifies the order block here, then zooms down into the lower time frame, and then looks into the lower time frame structure for any change of character, and then identifies an order block in the lower time frame and takes the trade. So in this scenario here, this trader here has identified a change of character in the lower time frame here and then taken his trade here, but then he never used a stop loss. So the market goes against this first trader here, but because he never used a stop loss, this may end up even blowing his account, because depending on the lot size that he used and the size of his account, this may end up blowing his account. But then let's look at a trader number 2 who also focuses on the first point of interest here, takes a trade and then puts his stop loss here. So when the market goes against his direction, he's stopped out. He takes a small loss, but then preserves his capital so that when there is an opportunity in the second point of interest here, then he has the liquidity, he has the equity to take another trade here. So once that happens, then this trader can take another position in the second point of interest here, once all the conditions of his strategy are met in this second phase here. And then you can see that after taking that trade, then the market goes in his direction. He might have taken some loss here or some losses here, but then in this second trade here, you see that the risk to reward ratio is 4.12, which means that whatever he lost here is in a position to recover here and even make some more profit. And this one, however small the profit will be, will end up piling or adding up in his capital, which will end up enabling him to stay longer in this market. So let's have an example of a real market where this scenario played out. You can see that the market is trending here. The market is trending to the downside. The bears are in control. There is this leg here which broke this structure, and we also have another leg here which ended up breaking this structure. So this market is bearish. Then the trader identifies this level here where there is an order block, which is the origin of this leg which broke this structure here. Then the trader zooms into the lower time frame. In the first point of interest, this is the point of interest in the higher time frame. So the trader monitors the market as the market moves. You can see we have some bearish pressure stepping into the market, but in the lower time frame the market is still bullish, so we cannot enter into any trade. So the trader waits patiently for any confirmation that the market is bearish, so that he can enter into the trade. So you can see that at this point here, this market ended up breaking this structure here, which is a change of character. The market also ended up breaking this structure here. So this is a confirmation that this market is bearish. Then we can also see that we have a fair value gap here which has been created. So this one is also an indication that the market is bearish. Then the trader waits patiently for the trigger so that he can take his position here. And this is going to be our trigger. We take our short positioning tool, put our stop loss there, and then target this point here. After this, then we wait for the market to either go into our direction or take us out, because now our stop loss will protect us from this trade if it goes against us, and therefore we shall have an opportunity to take another trade. But then you realize that the market ended up taking us out at this level, but there is no problem because we accept that the market has probabilities of either giving us money or taking money away from us. So we have to wait patiently for the market to give us another opportunity. But for the first trader, if you never used a stop loss here, then as the market continues going against your direction, then this will end up blowing your account. So at this point, we shift our focus in the second point of interest and monitor the structure in the lower time frame for any confirmation that the market is bearish. So at this point, you can see that this is the origin of the leg which broke this structure here. So you can see that the bears have stepped into the market and they are ready to take the market to the downside. then we cannot take a trade immediately, but we have to wait for the market to come back to us so that we can ride the move to the downside. Our main objective is to maximize profit. At the same time, we minimize our losses. So as I play the market, you can see that there is this level here where we have the fair value gap, and then the market came back to our level but impulsively moved in the bearish direction with a bearish engulfing candle. So this one is a confirmation that the market is going to the downside. But then we could have also put our sell limit here, so that when the market comes back at this point here, because sometimes the market may not come back to the order block which created the break of this structure, so we put our sell limit here and wait for the market to come, taps us in, and we target this level here. So if I play the market forward, you will find that the market ended up hitting our take profit and even moving down more. So traders, what I can say is that we have to prioritize preserving our capital, because we cannot enter into any trade in the market without protecting our capital, and we must devise the best strategy to protect our capital. And one of the tools that we have at our disposal is to ensure that we as traders use our stop loss. And the right way to use the stop loss is not to enter a trade without a stop loss, but rather put your stop loss at a predetermined place, so that when the market goes against you, it means that you never failed, but rather you are wrong in your analysis, and then the market will present you with another opportunity so that you can take another trade. Viewers, that is all that I had in this episode. Feel free to subscribe in our channel, the Smart Keys FX. Subscribe and hit the notification bell, so that whenever we drop any educative content like this, you will be the first person to be notified. Thank you for watching.